Now, one of the events this week that investors are going to be paying close attention to is the FOMC meeting. Now, the Fed has been facing a lot of questions about its decision to let inflation basically run hot. Prices are rising, but the Fed is signaling that this is only temporary and they're not too worried about that. So to talk some more about this, I want to bring in Kelsey Berro. She's JP Morgan's asset management fixed income portfolio manager. Now, Kelsey, we know the Fed is going to be meeting tomorrow and Wednesday. Do you expect them to defend their decision to let inflation run hot?
The Fed has been very clear that this time around, they're going to wait to see inflation before they react. In the past, they've relied on their forecasts, and their forecasts really haven't done a good job. Inflation has consistently missed the mark over the past couple decades, and this time around, they're doing a different approach. They're going to wait and see the data before they react.
So, Kelsey, what do you think the ultimate impact is going to be on the bond market, specifically the yield we're seeing on the 10-year? We know that it got investors into a frenzy a few weeks back when it rose so quickly. It seems to have stabilized right now, but what are your expectations for bond yields?
That's correct. Q1 was not a great quarter for the U.S. Treasury market. In fact, it was the worst quarter for U.S. Treasuries since Q1 of 1980. So it was a tough quarter. Yields rose. Expectations were improving. The economy was reopening, and expectations for growth were really going to levels that we haven't seen since the 1980s. So that was reasonable. Now we're seeing a bit of a consolidation, a bit of a breather here. People are reevaluating what's going on. But we do feel that as we move through the rest of this year, the economy is going to continue to recover. The Fed is going to move closer to achieving substantial progress on their goals. And therefore, we are going to move to an even higher yield regime. So when I think about the 10-year Treasury at 1.6% right now, I think we could easily get to 2% as the year progresses and the Fed moves closer to achieving substantial progress, which then means they're going to start tapering their asset purchases.
And Kelsey, do you expect interest rates to pretty much stay steady? Do you expect the Fed will continue to be accommodative as the U.S. economy recovers?
So the front end of the yield curve will remain pinned. So when you look at the 2-year yields, for instance, that's going to stay very low, very consistent with the Fed funds rate, which is going to remain at zero for the foreseeable future. For instance, the Fed itself is forecasting that they're not going to raise rates until beyond 2023. So the front end will remain pinned, but where you will see yields continue to rise is in the longer end of the curve. And that's because although the Fed is going to remain accommodative, growth expectations are rising, and as you already mentioned, inflation expectations are rising.
Well, what do you think the impact's going to be on demand for equities if we do indeed see yields become a little more attractive and start rising to that 2% level? Do you think that's going to sap any of the enthusiasm for the stock market, or can the two things sort of coexist?
The two things have been coexisting. And although I am a fixed income expert, I will say that we monitor financial conditions more broadly. The risk-free rate has remained very accommodative. Yields have remained low. And this is an attractive environment for risk assets. Even within the fixed income markets, we prefer to move out the risk spectrum into credit and high yield rather than staying in government bonds because of the improving growth outlook.
And Kelsey, what are you seeing in terms of trends with credit fundamentals tied to the recovery?
So one of the big trends that we've been seeing is although corporates are issuing a lot of debt, they issued a record amount of debt last year, and they're continuing to issue a lot of debt this year, what they've also built up is a huge pile of cash. So when you strip out that cash and you look at leverage excluding that cash, corporates are actually in a very good position. In fact, what we're seeing is that there are more rising stars than fallen angels this year, so lots of ratings upgrades. And we're also seeing that the default rate this year has been very low, and we expect it to continue to move lower as we move throughout the year.
And finally, what do you like right now in terms of sectors for this stock market? I mean, we're still in the middle of earnings season. We've got a packed calendar this week, but are there any areas in particular that you're either upping your exposure to or just staying away from?
So we're very comfortable with credit right now. Credit fundamentals are strong. As I mentioned, default rates are falling. There's more prospects for rising stars compared to fallen angels. So we're remaining overweight in terms of our credit exposure. And we're also staying away and being wary of getting too over our skis, particularly in the government bond markets. Because although the story for now is that we're far away from substantial progress, that the Fed is going to remain extremely accommodative, as the months go by and the economy recovers, we are going to be moving further and further away from that easy period of monetary policy and closer to a more tight monetary policy. And therefore, we will be experiencing higher bond yields, higher government bond yields, and we think you can get a more attractive yield and protect from higher rates by moving into things like credit and high yield.
Well, those are definitely good tips for investors. Kelsey Berro, thanks so much.